Good morning, everybody. This is Kathy with Premier Life and Annuities. Good morning. Welcome to another week with us of We Mean Business. Today I have Ellen Lamert. She is online with us. She's from National Life Group, Life of the Southwest. And I also have Mike Zimmeretti with us as well. He's also with us. He's our Regional Vice President from National Life Group. Ellen, go ahead and take it away this morning.
Thanks, and good morning, everybody. Thanks, Kathy. Hey, Mike. Hey, everybody. This is Ellen Lamert. I am a Director of Advanced Markets here at Life of Southwest, and we more fondly call it National Life Group. And Mike and Kathy asked me to share some information with you about a new program that we are now calling the Retained Earnings Trifecta. And if you'll have patience with me, I decided to use a little bit of a drawing technique and then our actual training program on the concept. So I'm going to go back and forth between a couple of PowerPoints. So if I'm looking a little confused at one point, it's not so much confused. I'm just going from one PowerPoint to the next. We are very excited about this program. It's got a particular market, and if you happen to have clients who fit a certain definition, a certain mold, this concept using a product that we call the Advantage 79 product will fit perfectly. And it works with that product because of the way that the product is built, the way that cash values feel lower in the beginning because we have all of the surrender charges built into the first 5 years, and then it really starts moving along. This page, this funny looking house, is just my way of quickly communicating the retained earnings trifecta market. These are clients who have C corporations or can create a C corporation. Concept's not going to be effective for partnerships or LLCs or those kind of organizations unless they are willing to put a C corporation in place, and we do see that. What you are looking for are the C corporations that have or may soon end up with a fair amount of retained earnings, those accumulated earnings, who have key people and who are personally interested in retirement accumulations. Any one of these can be the key issue that the client is talking about, but you'll see exactly what I mean as we go through the program. I just wanted you to be able to put your arms around who it is we're talking about. The other thing to remember about the Retained Earnings Trifecta program is that this is an amazing way to have a conversation with a CPA. Whether you're working with a CPA already or you're trying to bring that CPA on board, being able to express to the accountant that you may have a solution, one solution for 3 problems that many of their clients face, that's something they really want to hear about. Okay, so that 1 for 3 solution. So I'm going to have my system start drawing the concept. What I'm going to do now is essentially what I would call how you would describe this on the back of a napkin. If you were sitting with a client or sitting with a CPA, you have 2 or 3 minutes to describe the concept. This is how we do it. And from there, we'll actually go into the prettier PowerPoint that will help us go into some detail on each of these points. So this is the 2 or 3 minute conversation around retained earnings trifecta. And again, it's going to set the stage for you as we go through. So you're starting with a blank napkin, and basically I'm going to say to the client, I just want to draw a quick picture for you. And I'm going to start it out with a very simple balance sheet. You know, not a real balance sheet, but one that just demonstrates some of the key assets and liabilities that our retained earnings trifecta can help address. So assets and liabilities. The first thing that we noticed on your balance sheet was that you've been accumulating a fair amount of retained earnings. As a matter of fact, you have over $250,000 of retained earnings in your business, and that may very well be great news. Your business is doing well, you've been able to leave some money and have some assets grow on your balance sheet. The only problem is the tax code. That's kind of what comes into play sometimes in this. The code tells us that anything over $250,000 could be subject to an accumulated earnings tax. Accumulated earnings tax, by the way, let me get a little pen up here. Accumulating earnings tax is an additional 20% tax on top of any tax the business already paid on that accumulation. So if the business had been in a 20 or 25% bracket, they have already paid that. Now anything over that 250 may be subject to a 20% tax. Now the good news is if you've got a good reason for having that accumulation, the IRS won't charge you the 20%. If you have no reason or a bad reason, and the IRS sometimes has lots of cases on what's a bad reason, they will charge you that 20% on top. The other thing is when you decide to start taking the money out of the business, it will be treated as a dividend. So it's non-deductible to the business and includable as a dividend to the shareholder. Okay, so that's the first thing I've noticed. You've got retained earnings over 250. These are two different possible issues. The other thing that I know by talking to you is that you are a key person in your business. Your co-owners are key people. And what I get concerned about, and what is important to remember, is that even though a real balance sheet that you as an accountant or your accountant would draw for you doesn't show key people as an asset, you know that you are what makes this business go. So I'm writing you down as an asset for the business. What happens is if you die or become disabled, I would move you from an asset to a liability, because now with the loss of that key person, a lot of bad things can happen. Now, of course, if the client wants to know what those bad things are, I would, continue to discuss it, but I'm going to move on here because we're going to talk about that when we get to the other presentation. So retained earnings in excess of 250, key person, and the possibility of that key person passing away or becoming disabled. And then, of course, when we're talking about you, I'm going to put over here on the right your personal balance sheet. Okay, and on your personal balance sheet, I wonder about your retirement accumulations and how you've protected those retirement accumulations if you should die too soon or become disabled. So this is the retained earnings trifecta. One is the retained earnings, the excess over the 250. The other is key person. And then it's what are we doing to make sure that you are being as efficient as possible in building your own retirement accumulation and protecting that against the possibility of you dying too soon or becoming disabled. Well, I'm happy to say we have a special solution, and that is in the form of a specially designed permanent life policy. Now, we call that an Advantage 79 policy or an Advantage policy, and it's specially built to help address these issues. So how does it address issue one? Well, the retained earnings here. Because the policy is designed to take in more money than it accumulates early, so the cash value is going to be a little lower than what you put in on purpose, that will, in effect, reduce these retained earnings. So you'll go from whatever that number is down. And that can be effective for at least the first few years of the arrangement. The second thing is if the key person should pass away, we will deliver income tax-free death benefit to the business, and now this liability line would go away because you would have more than enough money to cover the loss of that individual, be able to recruit somebody new, and keep the business in place. And of course, if something happens to the individual where they become disabled, have a chronic illness, something like that, you do have access to the accelerated benefits. So we're protecting it on all ends. Then the key here is we recognize that if after a few years you no longer need that insurance for key person, what we're going to do is transfer the policy from the business to the insured owner, to you, for the fair market value. Now that will be treated probably as a dividend, but I'm okay with that, because if you've done it, if you've made that transfer, let's say in year 5, because of the way this policy is built, essentially you are moving retained earnings off the balance sheet at a discount. So if you had put in $500,000 of retained earning assets, essentially cash, you may have $400,000 of cash value. You're only going to get taxed on that $400,000, not the $500,000. So a 1-for-3 solution. We're able to use the retained earnings concept to get key person protection, to reduce your accumulated earnings exposure, and ultimately to have a very efficient way of building your own personal retirement resource that you can use on an income tax-free basis, and death benefit protection for the family, also delivered on an income tax-free basis. Now, I would then say to the client, I know we've done this fast, you probably have a whole bunch of questions. If this is a civilian non-accountant, they'll have one type of set of questions. If it's an accountant, they'll have a different set of questions. But the key is, if I've sparked any issues here, I sparked any desire to know more, let's set up a meeting and we'll go through it in a little bit more detail. So in less than 5 minutes, I'm able to describe the whole retained earnings trifecta concept. Now, the good news, folks, is that we are actually recording and going to have an animated version of this up on our new website. That's going to take us about 3 to 4 weeks from now. It's a good reason to keep coming back to the National Life Group Advanced Markets microsite. I'll show you how to get there towards the end of our time together. It lets you learn how to do what I just did, but what it also does is, you're able just to send that to a client and let them take a look at what's going on. So that should just put everything in context. We know we're looking for clients who have C corporations, who have been successful, may have some of these other problems. The presentation I'm about to show you will be up on the Advanced Markets website. Our IT folks were telling us it's supposed to be up today. There's actually a meeting going on right now where they're going to tell us what actually is working and what isn't. Again, I will show you how to find that site. You should come back periodically because we're posting a lot of new and interesting things on there. But this will be up there and available. I'm showing you the full version today. There is another version of this that essentially is, if this is 40 slides, that other version is 20 slides. It's a faster, simpler way of doing this presentation. Okay, here we go. The retained earnings trifecta, the 1 for 3 solution. So as I mentioned, this is a program for the owners of C corporations, and we do know that C corporation owners do share similar concerns, right? Any owner that you talk to, they're, especially in a C corp, worrying about increases in retained earnings because they know there could be an extra tax on that. They want to avoid unnecessary costs. They're going to want to provide the business with protection against the loss of a key person. If they die, they're co-owners. One of their other key people, an employee who helps bring in a lot of business, are they accumulating enough money for their own retirement? And how are they getting their personal life insurance protection? All owners, I know, once they get past the specifics of their business, doctor, dentist, lawyer, whatever it is, these are some of the things that they're worried about. Well, we are going to focus on 3 elements of these concerns. Those 3 key issues: retained earnings, loss of a key person, and your future personal needs, whether it's protection elements or gathering money for your retirement. Okay, let's go right to the retained earnings. And this is probably the more technical part of the presentation. What are retained earnings? How do they impact you? What is this nasty little accumulated earnings tax, the dividends? So let's start with a very basic balance sheet. And you can see we've X'd out all this other stuff just to keep our focus where we want it to be. And you'll notice if you take a look at a client's business balance sheet, on the bottom right, usually, you will see an entry in a C corporation that says retained earnings. And it may not be there if there aren't retained earnings, but I'm assuming in this example, the retained earnings of $890,000. Now, what makes up the retained earnings is no real retained earnings account anywhere, right? It just happens to be a way to balance the balance sheet. Because we know that if we add up the assets here, and we have $1 million of assets, and we look at the liabilities here, and there's only 100,000 of liabilities, and then we take into account anything called capital stock, we haven't balanced the balance sheet until we actually create this retained earnings entry. Very simple. What goes into there, accountants will tell you it's net earnings or increases in asset value, and that it will change on an annual basis. It's going to go up, it's going to go down, depending on what actually is sitting on the asset side and on the liability side. So it's pretty straightforward, really. As a non-accountant, when I say to accountants it's a way to balance the balance sheet, they kind of cringe at me, but that's the way I always thought about it. Okay. Excess retained earnings. Can you really have too much retained earnings? Well, the tax code said yes. In a C corporation, a regular corporation, you can accumulate up to $250,000 for any reason in the world. You don't have to have a reason for it. But when you get amounts in excess of $250,000, you have to have a reasonable business need. And the IRS is serious about this. They see if you leave money on the corporate level, you're avoiding potentially personal income tax or dividend tax on that. They don't want you to do that. Now, what's a reasonable business need? Well, accumulating funds to pay down debt, other things like that. We're going to take a look at that in a second. Now, in a professional C corporation, which in all honesty you don't see a lot, most of the time if you have a professional corp, they're going to make the election to be treated as an S corp. But if you run into one of them, their maximum retained earnings without a good reason is $150,000, and then anything over that, excuse me, you need to have a reasonable business need. And by the way, it's not casual. The IRS wants to actually see it. So what happens on these excesses? Well, bad news. You get a 20% penalty tax, again, on top of any tax that you already have paid on that money. So it's kind of a nasty result. Now, in this presentation, you have an option of skipping forward a whole bunch of slides if the client is understanding exactly what's going on. Let's say you're talking to an accountant, and the accountant really does understand what accumulated earnings taxes are, how do you avoid that, what are good reasons to accumulate. You don't need to do the next set of slides, but I'm going to take you through them, and you would just click here, and it's going to hopefully, yes, take you through to the next set. So what is the IRS going to ask about accumulations? Well, they're going to want to know, was the accumulation necessary? They're going to want to know, was the purpose for the accumulation to avoid paying tax? Did you simply say, well, I'm not going to take it out and pay, my 40% tax or whatever the number is. I'm just going to leave it in the business and let it run. IRS doesn't like that, right? So the other thing was, did you document the reason for the accumulation, and did you actually implement the program? So I've worked with clients when I was in my own law practice before joining National Life Group. I'd sit with some clients, IRS bound audited, have find them that they're 20%, or back a couple of years ago it was 15%, and you sit down and you say, well, they said, well, we indicated in our minutes that we were accumulating this money to buy new equipment. I go, great. Let me see a bill for some new equipment. Well, we're working on it, and it's 5 or 6 years into the accumulation. So in that case, the IRS argued that you never implemented the program. They win. Okay, so you have to do a whole lot of things. What are reasonable business needs? It's listed 8 here. You're accruing the income tax for the year. You need working capital. You're planning on expanding the business. You're buying assets. You've set up a special stock redemption program. You've got some litigation and you're creating a sinking fund. You're putting money away to retire some debt. And you've got some other potential business contingencies, need to recruit people, things like that. So these are reasons to accumulate the money. The other thing is that depending on what you want to do, one of your reasonable business needs, we know that we can help unlock the excess retained earnings by doing these kind of programs using life insurance. Setting money aside to replace the loss of a key person, doing the statutory buy-sell, entering into a business debt repayment, funding a split dollar, funding ESOP, repurchase liabilities, other executive benefit arrangements, informally funding those. So when you're looking at all those reasons, a subset of that is being able to use life insurance to both help move forward and implement the program, and then also if you're using our specially designed product, the product in and of itself helps reduce the retained earnings. So I'm not going to go into each of these in detail, but let me return to the main page, and I'm going to click the correct button here. So if you've got one of these reasonable business needs, and you have life insurance purchased by the business, and that policy, again, in and of itself, helps reduce the retained earnings, you're moving away from that 20% accumulated earnings tax, and that's all good news. Okay. The other part of having too much retained earnings is that if you decide to move it off the balance sheet, you will have to treat it as a dividend, right? If you take money out, money that's already sitting on the company balance sheet, it's not from new cash flow, and you reduce your retained earnings that way, when the shareholder receives it, they're going to get treated as having received a dividend. The biggest issue a lot of people have is when you make a dividend payment, it's a double taxation. It's not deductible to the business, so the business has already paid its tax, not going to be able to take a deduction for moving it out, and the person receiving it is going to have to pay their own dividend tax rate. Now, it's not an awful thing to receive a dividend. And just remember, all owners of the business have to receive dividends on a pro rata basis. If you give a dollar to one, you can give a dollar to the other, or whatever their pro rata share would be. So double taxation is not an evil thing. And actually, it may end up being that if you do go with a dividend distribution, that even at a 20% dividend rate, if the business only paid 15 or 20% on the business level, you may actually end up having taxes at about the same or less, even if you've ended up having a dividend treatment. The other part, as you'll see, the solution is if the money coming out is at a discount, even at a dividend, you're doing okay. Okay, so inside the world of retained earnings, two issues: the accumulated earnings tax, and if you want to take the money off the balance sheet, move it to the shareholder, it will be treated as a dividend. Okay, so that's that technical information. Let's move on to key person. You know, we talk about key people a lot. And using life insurance to protect against the loss of a key person is kind of a classic for a lot of businesses. And a lot of business owners think about it and sometimes just kind of get caught up in the technical detail of it. Now, the first thing is all business owners know who their key people are, right? It's the person who's got the secret sauce, the individual who gets the other workers really motivated and moving. It's the person with the imagination, looking ahead, people who can make the deal, all the folks who are working hard for you. And most of the time, the owners are the key people, and often there are other individuals in the business that are going to be key to the ongoing success of the business. Now, what kind of loss do you face if a true key person leaves? Well, there's a lot. There's the loss of market confidence. If your clients, if your customers see a key person gone because of disability, because they just get ticked off and leave because they pass away prematurely, those clients just might not have the kind of confidence to stick with you. You may lose a key skill set. What does it cost to replace that person? Bring somebody on board who's new, spend the money that's going to require, maybe train them. What about the clients who, because of all of this, go someplace else, go to a competitor? What about staff defections? I once worked on a case where we were doing some business succession planning, and after I got to know the client, we said, listen, I'm looking around, and you've got 2 or 3 key people here that if you as the owner would leave, they might actually pick up and go somewhere else because they don't have confidence in your succession program. Well, in this case, if it was just a key person who had passed away or become disabled, you still have the same issue. If they don't have confidence that the business will be able to continue past the loss of a key person, they could go someplace else. Business debt, bonding situations. What is the bank going to say if a key person has left or passed away? What are the suppliers going to say? And when you put this all together, what do your profits really look like after the passing of a key person? Most of the time, profits are down. So how are we protecting against that? Well, you value a key person. What are they really worth? And this can be tricky. There are a lot of different methods available. Some use a multiple of salary. If the person's earning 100, you do 7 times salary, and you protect by replacing them with $700,000 of death benefit or other protection. Some like to use multiple of profits. Some use a proportion of payroll. Others use actual impact. And when you look at all that, you start going, wow, that's those are kind of interesting concepts. It might be difficult to actually do a multiple of profits or an actual impact. I must admit, in my own world, I tend to go with multiple of salary because it's easy to understand. And by the way, as a rule of thumb, that is typically what the underwriters look at rather than all of this, unless you have some independent appraiser coming in and doing this for you. Okay, so multiple of salary is probably the easiest way to go on that. And of course, you protect that with insurance. Now, we move on to another concept. So we've looked at the first two parts of the trifecta: retained earnings, key person. Third part, your own personal future needs. And what we are suggesting is, because we are going to have the solution from the business in purchasing this specially designed permanent life policy, we can use that policy while it's needed inside the business to help reduce retained earnings or create a reason for the accumulation, to help recover the cost of the loss of a key person. But when that's no longer needed, whether it's 4 years from now or 6 years from now or whenever it's appropriate, what we can do is repurpose that policy, bonus it or distribute it out of the business, and now you've got a policy that continues your death benefit protection if you die too soon, gives you potential retirement accumulations, protects against living too long, and through the use of our living benefits will give you amazing protection if you should become ill. Of course, all those protections do exist inside the business, but now we're just moving it off the business level. And because of the way we're doing it, and I'll show you the numbers in a second, we're able to make that distribution essentially reducing retained earnings at a discount. Okay, so 3 issues, 1 solution. Let's look at that solution a little bit more. That's the specially designed business-owned life insurance. We call it the Advantage 79 product. And it's just kind of restating what I just said. It'll cover key person and retained earnings while it's inside the business, and then taking it out at the discount will cover your own personal future needs. So how is it going to work? Okay. It's going to start its life as a business-owned policy. So the business is going to purchase the life insurance. It will be used to fund that identifiable need. Remember, to avoid the excess retained earnings, we want to identify the need, whether it's key person protection, future liabilities, paying off debt, whatever it is. We're going to get that into the corporate minutes. Now, as far as the actual balance sheet, what's going to happen is you're going to reduce the cash account, right? You're going to write a check, pay for the premium. That reduces the cash account. And then the account is going to add a cash value life insurance entry, right? Because cash value is an asset. Now, one way that this policy is going to actually help reduce retained earnings is because the premium payment in year 1, and I'll make up a number right now, let's say is $100,000, and let's say cash surrender value is only $10,000. And again, depending on how you build the policy, it could be higher or lower, but again, just for argument's sake, let's say cash value now is $10,000. I'm going to write these numbers out. So let's say the cash value is $10,000. So that's now an asset on the balance sheet, and pardon my writing, I'm working with an odd little mouse here. But let's say the premium had been $100,000. Well, the difference between the two, that $90,000, is a reduction in retained earnings. And since that's what we were looking for, that's a good thing. Okay. Next, as we go through the years, whether it's 4 or 5 years or 6 years, at some point the policy doesn't serve the purpose inside the business anymore. We're going to transfer that policy to the insured employee, which will normally be one of the shareholders. They'll include the fair market value as income. So let's basically, after 5 years, that's going to be about whatever the cash value is in the policy. Now that, let's call it a dividend, will be taxable at 20%. But the net impact to the business is the money coming off. Let's say the cash value by that point is $400,000. Okay? Cash value is $400,000. Let's say the business had actually started out and has paid $500,000 for that. When they move this cash value off the balance sheet, we've reduced the retained earnings permanently, so now we solve that problem. The dividend is not going to be 5, it's going to be 4, so we've pulled the value of that money out at that discount. And yes, we're going to pay tax on that $400,000, but you know what? You can use the cash value of the policy to help pay for those taxes. Next, new policy owners got the policy, has all the rights to exercise, over living balance, the liberators, the accelerated benefits, all the things that make this a policy that you don't need to die to use. Okay. Now, additional premium payments may or may not be needed. If you full pay those 5 years, then you probably don't need to add any additional money to it, which is also another important factor for the policy owner. So let's just add some more detail behind how that balance sheet is working. Remember, the first promise that we're making, the first suggestion that we're making is we're going to solve issue number one, the retained earnings and dividends. Well, if we start with $890,000 of retained earnings and we have $100,000 in cash, and I buy a permanent policy. So notice I'm assuming that we paid a $50,000 premium, right? We went from 100 to 50,000. So I'm paying 50,000 in premium. Let's say we know that the policy at the end of the first year is going to have 10,000 in cash value. So now what have we done? We've reduced the retained earnings by $40,000. Plus, I've created a reason for having this life insurance, protect against the loss of a key person, as an example. And so this excess kind of gets folded in as well. So I've reduced retained earnings, created a reason for having the sum or all of the excess retained earnings. For key person purposes, well, if our individual insured had passed away, the business would receive income tax-free death benefit. Now, please remember, when you have a business-owned policy, you have to meet the requirements of Section 101J. Basically, that says you need to have a notice and consent signed by the insured prior to the policy being issued. It's going to provide a financial cushion. All that death benefit's going to come in. The business is going to have money. They'll have a little time to recover from the loss, and we'll have money for replacement and recruiting costs. So let's take a look at what that would look like on the balance sheet. So remember, the company purchased the policy. They spent $50,000 to do it, right? Okay, so we went from $100,000 of cash to the 50. We still have the retained earnings. We have that $10,000 of cash value in the policy. This is day one of year one. Well, if our individual insured had passed away, notice the cash value went away because we've delivered now $500,000 in this example of income tax-free death benefit. So our cash went up. Now notice our retained earnings also went up. Okay, you're increasing it because we've just added $500,000 of cash to the balance sheet. But you know what? There is a reason for that accumulation. It's being able to indemnify yourself against the loss of that key person. That money is going to go for smoothing out the reduction in profits, for recruiting new people, for paying money to new folks to bring them in, things like that. Paying down debt in case the debt was called. All right, third, so point 1 and point 2, reduce retained earnings. We'll create a reason for the accumulation, cover yourself in case of the loss of a key person. And what's next? 3, well, when the business needs change, we're going to transfer the policy to the insured. Remember, we're assuming that the insured here is the shareholder. That policy is going to come out and be treated either as income or dividend to the shareholder. And the amount that's going to be included will be about the fair market value, will be the fair market value of the policy, which is about the cash value, assuming that we're past year 5 here. And then, of course, our shareholder now has the policy, is going to be able to personally enjoy the benefits of the policy. Again, die too soon, live too long, become ill. I can't emphasize that enough. So there you go. If we transfer the policy to the insured, what's going to be included is the fair market value as income or dividend. So here's what happens. If I transferred it in year 1, which we probably wouldn't do, but it could happen. If I transferred it in policy year 1, notice that the cash value, let me get my pen going here, that the cash value, the 10,000, that entry is now gone because I've removed the policy from the business. Remember, I had, should have been 840, but I had the retained earnings. We pulled the policy out of the business, and now my retained earnings have been reduced permanently. And yes, this 10,000, give or take a dollar or two, would be included in my gross income or as a dividend. Let's say it was a dividend, I'd pay tax on it of 20% and can use the cash value to pay that tax. Okay, so that's how we get it. And then again, we have the personally owned permanent policy. Moving on. Is the concept right for the client? And this just pulls us back to who is the market, who do you want to talk to, and I can't emphasize enough, this is a conversation I think would best be started with a CPA. If you've got CPAs that you're talking to, especially now that they're deep in tax season, these are folks who are going to know which of their clients are running into these issues. And while you can't solve last year's problem, you can help prevent this year's problem from becoming worse. So have that back of the napkin conversation with the CPA. Take them out to breakfast before they go into work and say, if this comes up, I want you to give me a call. We might have a solution for you. So what we're looking for is an owner of a C corporation that already have excess retained earnings or are on the cusp of having excess retained earnings. Let's say you've got somebody who's got a couple of $100,000 of retained earnings. Last year they had a great year. They're right up at that moment, and if they do the same thing this next year and leave money on the balance sheet or asset values inside the business go up again, they could start running into that issue, start red flagging it from the IRS's point of view. This could be a great solution. You do want a business that has a need for life insurance. In the Trifecta conversation, we decided to focus in on the key person need. But as you saw earlier in our conversation, it doesn't have to be just key person. It could be funding for a non-qualified executive benefit plan. Let's say you put in a deferred comp plan and you want to informally fund it. Well, that's a reason to have an accumulation and to buy the life insurance. You're entering into a split dollar arrangement. Again, a good reason for having the accumulation. You have a client who's skittish about having to pay extra penalty taxes. They like to call it an accumulated earnings tax. I just call it a downright penalty. It's kind of a penalty for success. You've done well, you've left some money in the business, and now they're saying, well, you should have taken it out as a dividend and paid 20% on it. You left it in the business, we're going to charge you that 20% anyway. So you want to reduce that exposure. We can help you think it through. And then you have the whenever you see the word potential, you kind of know that we've had a conversation with the compliance department. But when you're talking to a client, look, you've got a desire, a personal desire for future benefits. We need to really consider how to efficiently accumulate money for your retirement, for your spouse's retirement, and how to protect that accumulation in case you die too soon. If you're 45 years old and you have a great plan for retirement, and then something had happened to you yesterday and you never get there, your family still needs that money. You still have to replace it. And by using this one policy, the Advantage 79, having it start out its life as a business-owned policy with the intent at the right time to move it off the business balance sheet to you and have that personally owned, you're killing a lot of birds with one stone. It's that one solution for the three problems. So the results. Business has life insurance coverage on a key person. That's never a bad thing. You can remember, because it's a business asset, they have access to the cash values. They have access to accelerated benefits. And assuming you've met the requirements of 101J, if the death benefit's paid, they'll get paid income tax-free. We've possibly reduced retained earnings. Now, we accomplish that by having the use of the Advantage 79 product, which is specifically designed to have less cash value in those first few years, because we're moving all of those surrender charges and expenses up the first 5 years. You could use a regular policy and you could dial up cash value, but because we want to get those retained earnings down some, we like using this product for that. The possible reduced exposure to accumulated earnings tax, again, by using the policy, in and of itself, you're going to reduce retained earnings. But it's also going to help you have a reason for having that accumulation. You're buying the insurance for a key person or a non-qualified benefit or paying down debt. And last but not least, eventually and ultimately, we would be repurposing the insurance to your own personal usage, again, at the right time. It could be 3 years from now. It could be 6 years from now. Optimum is around 5 or 6 years. And I say optimum because that's really when the cash value starts its upgrowth, its upspurt. You've paid up all of the surrender charges, you get to year 6, there are no surrender charges, expenses have gone down, and policy cash values really start growing at that point. But at that point, if you personally own it, now you're experiencing all that cash value growth. It's a great deal. You've got that very valuable asset out of the business. And in the process, have permanently reduced retained earnings. Okay, so what are the next steps? Besides finding the client, if you're talking to the client, you'd want to understand their current business situation. What are their goals? Is this going to be an ongoing business? Is it looking like a steady increase in asset worth and income? Or, are they kind of up and down? And one year they have a lot of accumulated earnings and the next year they don't, becomes less of a problem. So we want to understand exactly what's going on inside the business. Next, going to analyze that information. We're going to take it back and take a look and see if your business and the way that money's coming in and going out could use this kind of a program. And what does your personal balance sheet look like? We're going to review options and opportunities for you. This may very well be a solution. It may be very well that we need to look at another solution, another classic solution for at least 2 of the 3 issues in our trifecta, the retained earnings reduction and the personal retirement and protection. Sometimes we find that qualified plans and having life insurance in a qualified plan is a solution for those situations. And sometimes we do both. Sometimes we're doing qualified plans and having the business-owned life insurance and get those retained earnings down very significantly. And at that point, once we've done all that, we can help you and we'll help you implement whatever the appropriate strategy is. Okay, so that's our 1 for 3 solution. The retained earnings trifecta, it's where you're going to have a business-owned policy specially designed to achieve reduction in retained earnings for a period of time, get you income tax-free death benefit as key person insurance, and then help you at a discount if you do it in the right year, get money over to, or get the policy over to the shareholder for their own personal use. So that's our 3 for 1. Now you saw me start by doing the line drawings, and you can see that you can take that concept, give a lot of information in a fairly long PowerPoint. Our other PowerPoint presentation on this is half the size of this and doesn't go into the kind of detail on what accumulated earnings are and how do you avoid those. It just gives you some talking points on that. Okay, I'm going to close this down for a second. And I'm just going to show you a couple of the other pieces of material. I know it just went blank. Don't get upset about that. Mainly because I'm looking for a document that I should have brought up before I signed on. Here we go. I just wanted to show you the flyer that we've got here. The retained earnings trifecta flyer. Let me make it smaller so you get a better shot at it. Shows you one of those great Venn diagrams where you have the intersection of these 3 things. We have that amazing solution for you. So it talks about or demonstrates if you've got retained earnings, if you have a personal insurance and retirement need, if you're worried about the loss of a key person. When these come together, we have this unique product solution that can help avoid or make these 3 issues kind of go away. And then the next page goes very simply through what we just did in the last half hour or 45 minutes. It talks about the retained earnings. It talks about the loss of a key person and your personal insurance needs and how our special product solution helps meet those needs. Okay, and then it talks about the next steps. This is available. It's compliance approved. Now, we were hoping that we would have this all up and ready to go inside our new microsite, and I'm going to show you how to get, I believe it's going to be posted today, if not in the next few days, and it's very simple to get to. All you have to go to is www.nationallife.com. This is the public site. You go to financial professionals, and you'll see in there, if I can do this right, is advanced markets. So the public site, www.nationallife.com, go to financial professionals, and then go to advanced markets and select that, and then wait. And okay, it's not up yet, but what you'll see is our special microsite. It has the overview of the department. It's got the what's new material. We change that every 3 to 4 weeks. Right now, the substantive area that's up is by cell. I'll just click on that. And then hopefully sometime today or in the very near future, so keep coming back to look for it, the next piece that will be under here will be retained earnings trifecta, and it will have all the material appropriately listed in the different spots, including consumer literature. And we are just building the agent training program. So again, just drop into www.nationallife. Periodically, you'll be able to come in and see all this new stuff. Okay. I'm happy. Kelly, I'm not sure about taking questions, whether you want them live or.
Ellen, I'm not seeing any questions right now. I don't know if anyone's ever typed it up. I'm just not seeing anything coming up this direction. I think you've done a wonderful job. Very, very self-explanatory, detailed out there. If anyone has any questions, they can get a hold of us or they can get a hold of you because you showed your information out there. But do you want to give your number one more time?
It's actually, if you go up to the website, I'm going to promote the website. If you go up to the website,
thank you.
Here's our 800 number. Or if you want to get directly to any of the team, you just go to our team and meet the team. And that's me right there, smiley face. And it's my direct line and email address along with the rest of the advanced markets team.
Wonderful. And if you call in, make sure that you mention that you were on the We Mean Business webinar. That way they know, who you are, who you're calling in about, or what you're calling in about. A little bit helps them a little bit there. Otherwise, you can call Premier at 1-800-365-8208 and just ask for a life marketer. And someone did put out there, is this available in Florida? And
yes,
yeah, correct. Yes, you're in all states. Is that correct?
Yes, we are.
You're in all 50 states. Okay.
Yes,
wonderful. And that brochure is not available out there just yet. But Ellen, is there a way I can have?
I will send it. I'll send it off to you and
thank you.
and Mike, and make sure everybody's got it. I'll send you all the PowerPoints and the brochure, and hopefully it'll be up on the website soon. But I will get it to you today.
Wonderful. I appreciate that. Again, someone else just came in. Is the napkin presentation on the line also? And
it will be in about it'll be we're just recording it now, and it's got to go through creative and through our compliance group. So I always say 2 weeks, and it's probably more like 3 to 4, but it will be up there. Keep your eyes open for it.
Wonderful. All righty. Well, thanks, Ellen. I appreciate everything that you did for us today. And Mike, if you're still there, thank you for joining us.
Yes, my pleasure. Thank you.
Wonderful. Do you have anything to say or add? Mike?
I think Mike's at the airport.
Oh, he's at the airport. Getting cut off. Okay.
Yeah.
Well, let us know if there's anything else out there for you guys. Take care and have a great day.
All righty.
Thanks, Ellen. Appreciate it.
Right. Bye-bye.
Bye.